So, the year's over, and you've got a pile of numbers from your business. But here's the thing. Do they actually tell the whole story? Today, we're going to dig into your accounts and find the real financial story hiding in there. And it all starts by asking one really important question.
I want you to really think about this for a second. That profit number you see at first glance, is that the absolute truth? Well, the answer is almost certainly no. But don't worry, that's totally normal, and we're about to figure out exactly why.
You know, the best way to look at your first set of accounts is to see them as a rough draft. All the basic ideas are there, but it's missing some really crucial edits. Our job today is to make those edits, we call them adjustments, and turn that rough draft into a final, polished story that shows what really happened.
So why do we even have to do this? Why can't we just trust the first numbers we see? Well, it all boils down to one simple thing. A mismatch between when money actually changes hands and when the business activity really happens.
Okay, this right here, this is the most important idea we're going to talk about, the accrual concept. See, proper accounting isn't just about tracking cash flowing in and out. It's about matching your income to the period you earned it and your expenses to the period you used them. This one concept is the reason our rough draft needs so much work.
All right, so let's jump into our first set of edits. We've got to make sure all of our expenses are landing in the right time period. This is all about getting the timing just right.
An outstanding expense is a perfect example. So imagine your team works the last week of December, but payday isn't until the first week of January. Well, according to the accrual concept, that salary is a December expense because that's when the work was actually done. If you don't account for it, you're making your December profit look bigger than it really was, and that could mess up your budgeting for the next quarter.
And this is where it gets kind of cool, because this slide shows you it's really two sides of the same coin. On one hand, you have outstanding expenses, costs you've already benefited from but haven't paid for yet. On the other hand, you have prepaid expenses, things you've paid for in advance, like next year's insurance premium, but haven't used up yet. One's a liability, the other is an asset. It's a perfect balancing act.
Okay, so we've sorted out our expenses. Now, let's flip the script and look at the income side of things. And, you guessed it, the exact same timing problems can pop up with the money you're earning.
Accrued income is basically money you've earned, but the cash isn't in your bank account yet. Let's say you finish a big project for a client right at the end of December, but they're not going to pay that invoice until January. Well, that revenue belongs in your December books. If you forget to include it, you're understating your profit and getting a skewed picture of how well you actually did that year.
And just like with expenses, you can see the perfect mirror image here for income. Accrued income is an asset. It's money that's owed to you. But unearned income is the opposite. That's when a customer pays you up front for work you're going to do next year. That's a liability because you now owe them that work. Getting this right is absolutely crucial.
All right, we've got our timing locked down for income and expenses. The next big piece of the puzzle, making sure the value of all your stuff, your assets, is stated correctly on your books. It's not just about when, it's also about how much.
Let's talk about depreciation. When you buy a big-ticket item like a machine or a delivery truck, you don't just count the whole cost as an expense in year one. That wouldn't make sense. Instead, you spread that cost out over the years you'll be using it to make money. That little piece of cost you account for each year is depreciation. It's the very real expense of your assets getting older and being used.
So what does that actually look like on paper? It's really just a four-step dance. First, you calculate the amount for the year. Second, you record it as an expense, which, reduces your profit. Then, you also reduce the value of the asset on your balance sheet. This keeps everything in balance while showing that your asset isn't worth as much as when you first bought it.
Now, this is where you have to pay super close attention. It's all about one tiny detail. If the rate just says 10%, you take the full year's worth of depreciation no matter what. But if it says 10% PA, that stands for per annum, you have to factor in time. An asset you only own for 6 months only gets 6 months of depreciation. Those two little letters, PA, can literally cut your expense in half. It's wild.
Okay, next up for valuation, your inventory, or what we call closing stock. This is just a fancy term for all the stuff you have on your shelves that you haven't sold by the end of the year. Getting this number right is critical because it directly impacts your cost of goods sold, which in turn impacts your profit.
So how do you put a price tag on it? Well, the rule is simple and pretty conservative, all thanks to something called the prudence concept. You value your stock at either what you paid for it or what you could sell it for today, and you have to pick whichever one is lower. This basically stops you from overinflating the value of your assets and counting your chickens before they hatch.
Okay, deep breath. We've covered timing, we've covered valuation. Now let's pull it all together with one last, kind of tricky adjustment that really shows why all these little details matter so much.
This one's a classic accounting brain teaser, the manager's commission. The deal says the manager gets a cut of the profits. Simple enough, right? But is that a percentage of the profit before we've taken out their commission as an expense, or is it a percentage of the final profit after we've taken it out? The wording changes everything.
And as you can see, this leads to two totally different formulas. The before calculation is easy. It's just your standard percentage calculation. But the after formula is a bit cleverer. You add the rate to the bottom of the fraction. So you divide by 105 instead of 100, which correctly calculates a percentage of that smaller final profit number.
And wow, look at the difference that makes in practice. Using the exact same profit figure and the same 5% rate, just that one little word in the contract, before or after, changes the final commission amount. It's a perfect example of why precision is everything in accounting.
And that right there is the whole point of what we've been doing. All these little tweaks and edits for expenses, for income, for depreciation, for commissions, they're the things that transform that messy rough draft into your official, accurate final accounts that tell the true story of how your business performed. So, at the end of the day, why do we go through all this trouble? Because when you do this, you get the real story. Your true profit is finally revealed. You know exactly what you own and what you owe. And with that knowledge, you can make way better business decisions. Plus, everyone else, investors, banks, you name it, can actually trust your numbers.
At its heart, everything we've talked about is about creating a financial record of your past that is accurate, that is true. It's about being able to look back at the last year and say with complete confidence, yep, that's what really happened.
But I want to leave you with one final question to chew on. Now that you have this truly accurate picture of your past, what does it tell you about where your business is going? Because these true numbers, they aren't just an endpoint. They're the starting line for your entire future strategy.